Hello, everybody. Welcome to the CII workshop webinar on zero budgeting and OKRs. I'm really grateful to Neelesh Gupta from Deloitte for doing this specially for us. The context of this is we had a previous webinar on how to manage cost cutting, HR, and such under COVID-19, along with Neelesh and Talish Ray, and almost all the participants had asked that, look, you are mentioning these two great concepts, zero budgeting and OKRs. We really want a focused workshop on this. And thank you, Neelesh, for really, I think, 4 or 5 days, right? It was all put together in 4 or 5 days. Thank you, everybody, for joining. We are just seeing participants come in. We want this to be a workshop. So if you have questions, if you haven't understood something, we'd be very happy to a little bit go over it again. In the next one and a half hours, we want you to leave feeling confident that you have completely understood at least the basic concepts and maybe even a couple of trials. I will be posting links to our Telegram channel where both Neelesh and I will be posting some follow-up slides, some OKR booklets, some zero budgeting templates and such, which we've collected. And I look forward to this. Once again, we will be using the Q&A system here. We won't be using the hand raise system. So if you have any questions, please click on the Q&A thing. And I still see we have a few people joining. So Neelesh, just to kick things off, how are you seeing the change between what we talked 5-6 days ago on HR and now? Are companies coming back to you and saying, look, we have to take urgent decisions? How is this COVID-19 thing moving? I mean, the lockdown's almost over, right?
So saying it's almost over is something which is a big myth at the moment, Aditya, because...
Exactly, right. The Prime Minister is going on television tomorrow and we might
tomorrow is 10 a.m.
have, right?
So yeah, that is when I think we'll get to know the exact story. But in my limited opinion, I think a lot of states have extended the lockdown, and we should expect things along the similar lines tomorrow also. What happened on a funny note in the past 1 week is that a lot of organizations that we work with monitor EBITDA. What is EBITDA? It is running before interest, tax, depreciation, and amortization. Now, the new thing that is coming up is EBITDAC, EBITDAC, earnings before interest, tax, depreciation, amortization, and Corona.
And I think a lot of people who are trying to raise money are probably focusing on EBITDAC rather than EBITDA. On one hand, I think it's a more faithful recording of what actually happened in the business rather than there, but nor does it really tell you what's going to happen in the next 6 months, right?
Correct. But what we're definitely hearing from organizations now is really frenzy around cost consciousness. And specifically from an HR standpoint, there is a huge consciousness on discretionary cost optimization, which is picking up steam, because like we talked about last time also, employee cost is a sensitive matter, and probably it will be the last on the agenda of people. But discretionary costs is something that may end up being the first on the agenda of people to optimize on costs.
I can completely understand that. Now, we're just going to wait a couple of minutes to make sure that we have everybody in, because I don't want people who are a minute or two late to sort of miss out on the entire context and all. So I think we'll just start everybody in a couple of minutes. If there's anything in specific you'd like us to cover, please use the Q&A thing to start asking us questions, or feel free to send us a chat. We will try to focus on those things. Once we start, it's going to be a very structured conversation here, and which I'm hoping we'll try and get through quite quickly, especially on the major things. Brilliant. So what I'm going to do quickly is, while people are still joining in, I'm going to share a quick slide and walk through why we are even doing this. And I'm going to share one slide now. And then I'm going to share one slide once we, move to the OKR part of it.
Perfect.
Neelesh, can you see my screen? If you can see it, everyone can.
I can see it.
Great. So I just want to take a step back and really try to ask a very, very important question, right? What are most organizations trying to accomplish right now, right? So we're talking about discretionary cost cutting. We were talking about figuring out ways to manage HR costs. Uh, in our last conversation, we put several options on the table. We put people taking pay cuts. We talked about furloughs. We talked about people going on breaks or leaves without absence for 1 or 2 months until companies got back on their feet. We talked different solutions for different industries. And we also talked, of course, difference between various types of employees. And we didn't really go into the legal aspects, but there was this understanding, permanent versus contractual versus just joined versus old, right? And so I'm going to sort of walk through what are we trying to do? Well, first is what we're trying to do is we're trying to preserve cash flows and the ability to stay afloat by cutting down on costs now rather than taking these drastic measures after 90 days. And I think this is a very important point because a lot of organizations are saying, look, we have a little bit of cash and let's wait and watch. And the problem with waiting and watching is that it's better to take small, not drastic actions now than to take big, drastic actions down the line, right? And so do it now and cut down costs rather than saying 90 days, 6 months, we'll see, even if you have lots of cash and your business model is not completely upended. Now, this is the other problem though. You're saying cut, but guess what? There's a new reality post COVID-19, right? And so what you knew about your business, what you knew about who is important to your business, who's driving revenues, where you're getting things, what are your projects on the line? Maybe something was a very critical project right before COVID-19. Post COVID-19, it's no longer there. Maybe there are new opportunities that have presented themselves. And the entire problem that companies and organizations are running into is trying to do this all within a very short period of time. On one hand, they have to cut costs, but guess what? Their old costs, their old systems, their old who's important, who's not, who's essential is no longer valid, right? And on the other hand, they're trying to create a new organizational structure to say, okay, post COVID-19, what can we do, right? And both in the short term and in the long term. Neelesh in the previous webinar had talked about the 6 month, 3 month, 6 month, 9 month, 12 month, 18-month framework on who do you need when. And the fact that, honestly, if you need someone within the next 12 months, maybe firing them right now or asking them to go on, is not the best idea. There's probably a better solution, but how do you know who you need, right? Because in a post-COVID-19, your business model could be completely different. And the next part is, we want to make sure we're not panicking, right? We want to make sure we calmly and strategically make decisions and have data in advance. So when decisions need to be made, are made thoughtfully. What does that mean? So it means, look, maybe things in 1 week, 30 days, 90 days will be okay for your business, right? But if they're not, you don't want to be running this exercise then, right? You should already have the data with you. You should understand where can you cut and how much can you cut. And you can take that decision when you need to. Just because you have the framework, just because you have a list of things you can do, doesn't mean you have to do them. But it also means that when push comes to shove during that crucial time, right, you know what you have to do. You aren't scrambling for data the night before that bank loan is due. You're not scrambling for data the week when the revenue numbers come in and you realize, oh my God, I can't meet payroll next month. You have a plan in place, you know what to do, you know where the cost cutting can happen, and you know how it is going to happen in a strategic and calm manner. And of course, the big thing, what we want to do is be ethical and compassionate. And the only way you can be ethically and compassionate to your employees, make sure that they're taken care of, make sure that this huge pandemic burden that has come on us as businesses, on us as employees, is shared. And that we can make sure that there's an ethical, rational, compassionate way to do it. And the only way you can be ethical and compassionate is that what you do is well reasoned and early, right? In in 30 days, 60 days, 90 days, a large number of companies will go bankrupt. A large number of people will be out of a job. And there are certain industries where this is guaranteed. You know, your tourism sector, your hotels, your F&B, restaurants, airlines, all of these are guaranteed to have a huge manpower hit. You don't want to have somebody enter the job market at that point. The ethical and compassionate thing to do is to take hard decisions now so you can make sure they either have a job in 60, 90 days and they can return to normal as the company returns to normal. Or if you need to let them go, you do it early on and then you put in the support infrastructure to help them transition now and give them some basics, whether it's rent, food, minimum money, so they can get through this time without having to worry about that. If you wait, they are going to enter a market which is very different. So early is better. And having a well-reasoned, rational initiative is always better than something arbitrary like, hey, everybody, let's take 20% off a pay cut. I love what Neelesh had said then. It's a very foolish thing. It's a great PR. It's great PR. We are all hurting. Everybody takes a pay cut. But that's not going to accomplish number one and number two. Maybe 2 or 3 people who are very expensive to the organization and are not strategically required anymore, or a couple of departments, better to bring them down and downsize them than do arbitrary cuts even for your highest performers. And I'm going to end here on the spot and hand it over to Neelesh to sort of walk through the zero budgeting. The need and opportunity post COVID-19 requires a fresh approach. So the traditional approach of HR budgeting, the traditional approach of structuring is not going to work for us now. And zero budgeting is one of those tools, very effective tools that allows you to add people rather than delete people. And that's a very healthy attitude. Who can I add to my team rather than who I need to delete from my team? And the last bit I'm going to comment on is that when you're looking at the zero budgeting, my big advice is for you to try to separate the role from the person. The role might be incredibly important, but the person who's doing it might be a poor performer or someone who's not suited for that role, right? You still may need the role. You may not need that person. The converse also is true. You might have a fantastic, amazing, brilliant person, but the role they are doing is no longer needed by the organization. And then you have the opportunity to bring that person into another role that does deliver for the organization. And so when you're thinking about this, also remember, remove roles and people. They are 2 different decisions, and each one of them can be handled in a much better way. I know there are some people raising hands. I apologize. We can't unmute people at this juncture. What I would recommend is please use the Q&A button to ask questions. If you are unable to figure out the Q&A button, please send me or send Neelesh a chat. Raising hands, unfortunately, is something we can't work on in this version. And so please send us a question or please send us a chat. Neelesh, over to you, please.
Thank you so much, Aditya. And in fact, the first and most important point that you mentioned was the fundamental of this discussion, which is preserve cash flows and find out where is it that you really need to spend and where is it that at the moment, I'm not saying for the rest of the life that the organization is to survive, but at the moment, spending cash would not yield results. The fundamental, and while I'm putting the deck on play on the screen, is to say that the fundamental reason why zero-based budgeting or traditional approaches of budgeting are left behind and things like these are put up is in situations where you actually question on why is it that I need to make a certain expense? What is the prudence of making this expense? Will this expense yield? Now, the why part in prudence and the yielding is most important from a zero-based budgeting standpoint. Those are the 2 fundamentals on which this approach is working on. There's a certain bit of history that I would want to jump into before I get into the text of zero-based budgeting. You're able to see my screen, right?
Absolutely, super clear.
Perfect. Great. So traditionally, how have we been making budgets? How have we been making budgets? If some of you who would have worked in the budgeting exercise for your organizations would have said that you will list down the activities. Those activities could be, let's say, activity 1, activity 2, activity 3, and so on and so forth. And there is a good base that you have. You said that this is a recurring activity. Since I spent 100 rupees on it last year, there is a certain form of inflation that has come up. There is a certain increase in volume, or there is a certain decrease in volume. You'll do these two adjustments and arrive at a new numbers, which will be basically a percentage increase, and say that mota if you need 10% increase, then the new budget for this year is 10%, 110 rupees. Now, historically, this works for managers because organizations work on the central premise of having recurring expenses in nature to continue their day-to-day operations. And therefore, since the price of goods and services keeps escalating, you need to keep increasing this budget depending on where the necessity is, and so on and so forth. And therefore, the budgets get formed. Zero-based budgeting, imagine that there is a new person, or imagine there is a kid who has come into your organization and who wants to know that, hey, look, why do you want to do all of this? You want to spend 100 crores of rupees. Why do you want to spend all of these 100 crores of rupees? Now, the kid doesn't understand, right, that on TA expenses, you spent X rupees last year, and therefore it is going to be X plus delta this year. The kid also doesn't understand that on, let's say, incentive payout, this is the money that you spent last year, and therefore the incentive budget pool has to move forward as a carryover for the next year, and so on. So the kid will ask you that, hey, look, mister, why do you want to spend this money? And that is where the concept of zero-based budgeting comes into play, wherein you say that every activity that I'm going to work on will start with a base of zero. So zero-based budgeting basically says that you start with a base of zero. And then within that activity, you list down what are the sub-activities that may be required. You start allocating money to those sub-activities. And once you have allocated money to those sub-activities is when you start doing an addition on saying that, acha, these are the 10 things that I needed to do in these activities, and therefore here is how my budget is going. Now, this is the prudence part. I also talked about the yield part. Now, how does the yield come into picture? For every expense statement in zero-based budgeting, and this is more from a finance standpoint than from an HR standpoint, but we'll bring in an HR element here as we progress. To say that for every expense, there has to be an income generation, because at the end of the exercise, money doesn't grow on trees, right? It has to come from somewhere and go out somewhere. So therefore, for every expense, there has to be an income. For every activity, there has to be a return on that activity, which either has to contribute to the top line of the organization or bottom line of the organization. So in this humongous Herculean exercise that you set out for yourself, you will list, you'll break activities into sub-activities historically. And then with all of those sub-activities, you'll do a prioritization. Yes, no is the simplest form of prioritization, whether I need it, not need it today. Once you have done that, you will mark for the activities which are yes, what is the prudent cost that you need. And once you've done that, then that is what you would mention from an ROI standpoint, that if I were to spend this much, what is the return that I'm going to get? Typically in a finance function, you would do it the other way around. You would first list down the income statements and then put expenses against it. But from an HR standpoint, let's work in a way wherein we're used to being a cost center, and therefore we list down expenses on what we are spending. But this time we put an ROI for every penny that gets spent and link its direct contribution to top line or bottom line. Anything which does not have this contribution gets knocked off. That is the next hard principle of zero-based budgeting. So therefore, now summing it up from what is zero-based budgeting? Zero-based budgeting, as it is there on the screen, is a method of developing a budget from scratch or zero base, which therefore means that you do not assume that there are certain expenses which have to be incurred. There is no expense which has to be incurred. Since there is no expense which has to be incurred, it therefore means that you will break each activity into its sub-activity and then say that here are the things that I need to do, good to do, must have, whatever classification you find it to be appropriate, you put that classification And then for each of those sub activities, what is the expense that you will incur as an organization, and what is the return that will get generated, which is going to contribute to your top line or bottom line. Now on the screen, you'll see two tables, right? One table is basically talking about traditional budgeting, where you said that if my income was for the three activities 100,000 rupees, expenditure was 100 rupees, you take a flat 10% increase and say, Acha, I will do income as 1100 rupees and therefore the expenses will be 100. This is a good, reasonable way of having a quick and dirty work of budgeting being done and getting along with the way of life, which we do most of the times and across year on years. But in tough times, you delete what you did last time. You remove that lump sum percentage increase, and you get into a zero base. You say every activity will start from a zero base. Now in traditional budgeting, what we also do as many a times as blunders is that when either your board or your CEO or your CFO, these are the three authorities which typically end up approving a budget, they do it at a functional level. Now what does a functional approval of a budget mean? It means that HR as an overall function is going to have a budget of 100 crores. Now within this 100 crores, Mr. Function Head, in the name of empowerment, do whatever you want within that 100 crores. And next year that 100 crores will become 110 crores, after that 121 crores, and so on and so forth. Zero based budgeting puts a stop to that. It says that it will not be at a functional level, it will not be at an aggregated level, it will be at an activity level. Many a times we also try and use words like activity based costing when we want to exercise prudent cost measures. So this was fundamentally on the definition of zero based budgeting. Now we'll try and get into quickly putting into place how do you put zero based budgeting into action in today's time. Today we are going through some times which are fairly unprecedented in nature. It is very clear that at least in my living memory, I have not seen such a time. I hope that I do not see such a time once again in my living memory again. But now that we are in it, it is incumbent on us to find ways and means to get out of it and get out of it successfully, get out of it to be more aptly, and so on and so forth. So before we get into zero based budgeting for HR, let's have a look at what does HR cost structure look like. What are the elements of an HR cost structure, and where is it that zero based budgeting can apply? There are two parts to an HR cost structure. On the left hand side, you will find what is known as discretionary costs. In common parlance, it is also known as HR budget. HR budget comprises of your travel expenses, R&R expenses, training expenses, hiring expenses, some discretionary benefit expenses if you're doing, and so on and so forth, multiple other headers that come in. Now go back to the previous slide that we were talking about. Those activity 1, activity 2, activity 3 are the headers which are mentioned here. Travel expenses is activity 1, R&R expenses is activity 2, and so on and so forth. These are discretionary in nature, which means at the discretion of the human resource function to either spend on these or not spend on these. On the right hand side comes in non-discretionary costs, which are your costs which by virtue of contractual obligations or by virtue of your business cycle you have to end up paying. So like for example, payroll cost, your fixed salary cost any which ways will have to be paid month on month, irrespective of how your production levels are going to be, because as per the contract that you signed with your people, it is obligatory for you to make those payments. I'm not talking about force majeure conditions. I'm not even talking about situations wherein some of you can raise a question and say that travel expenses are also a necessity of the business and so on and so forth. Travel expenses for the moment stay in discretionary. Fixed salary cost for the moment stay in expenses which you're obligated to pay month on month. Now, as a concept, we would recommend to you to first apply a zero based budget on your HR discretionary costs, or the so-called HR budget, to develop all of these from a zero base. And then if you think that there is still a need for you to manage costs in such a way that that the organization won't survive without this cost control is when you got into zero-based budgeting for a non-discretionary cost element that has been described over here. At the same time, do a budgeting, but do phase-wise implementation. Don't get into panic implementation mode. Like we've been always saying in the last webinar also, while Aditya also stressed on it, do not panic. Take carefully thought through calculated actions. Now, coming on to
Nilesh, I just want to clarify because I'm getting some questions on this. Just to be sure, I just want to iterate what Neelesh said. The difference between a discretionary cost and a non-discretionary cost in this list is purely a legal basis, right? If you do nothing tomorrow, you could say that I will stop paying everything on the left, right? This is at your discretion to pay or not pay. Of course, you might have vendors and all who have maybe travel, this, that, etc. But you can say you can send out a memo. Nobody's going to travel. Anyway, you can't. You're quarantined, right? So your travel expenses goes to zero, right? You say, look, I don't want to do any more hiring freeze. Your hiring expense goes to zero, right? There's a lot of wellness, yoga, training. We don't have money to do it, and the government is not allowing us to do it. That goes to zero, right? So all of those, which you can quite frankly, by just saying stop, can be stopped, right? The ones on the right are where you have to take an active measures to stop, either by renegotiating contracts with employees, taking hard decisions on the HR front, because unless you take action and take strong action, you are obligated to pay these costs. You cannot get away from paying them. Now, I want to quickly make a difference. Some of you might think, well, in order to survive as a business, I need all the discretionary costs. That is correct, but that is a business model issue. What we are talking about is purely costs from a legal perspective. The discretionary costs, which you can stop today without any consequence legally, and on the right, which are the non-discretionary, which you cannot stop right now unless you actually take concrete initiatives. And so the zero-based costing, what we are saying is to look at both of these and say, from my business model, what can I change on the left and what can I change on the right? Perfect. Thank you. Please go ahead. We had some questions there.
Thank you so much, Aditya, for giving that overview. Now we'll get on to an example of zero-based budgeting. And for an element of HR budget, we'll first talk about how is it that you do zero-based budgeting, since Aditya said two things. Number one, he said that, hey, look, just bring them to zero and say from tomorrow, I'm not going to spend. Like, for example, in TA, which is talent acquisition, you say hiring freeze, no money to be spent. While some of you may come back and say that, hey, look, there are critical roles, we need to hire, future perspective, and so on and so forth. So we'll talk about in such a scenario, how is it that you should budget? And the second part, which we'll be trying to visualize together, will be around for non-discretionary costs. How can you think of using zero-based budgeting for such cost elements and therefore realign your cost over a longer term? Yeah. So the first way, like I said, the traditional way is that you pick up last year's budget and you say that, which is number one listed over here. This is my pointer also visible on the screen?
Let me check. I think it's, yes, it is. It is perfectly visible.
Perfect, great. Number one says here, what is the last year's budget? So let's say the activity was talent acquisition, which is classified as recruitment in monthly basis. For FY20 was 5 crores. If you were to apply zero-based budget, you would make it as zero for FY21. You would say that there is going to be a zero budget with reference to a base of 5 crore last year for talent acquisition in this year. Perfect. Now, what is it that one should do? How is it that I would do zero-based budgeting? Break the activity of talent acquisition into its constituents. And we will do both the things. We will do prudence in terms of why is it required. And at the same time, we will take certain calls in terms of how is it that you can change these. So why is a talent acquisition budget required? It is required to hire people. You do talent acquisition because you need to hire people. Why do you need to hire people? Between man and material, man is the part which comes through recruitment. Therefore, recruitment is the most critical HR process. Agreed. Where do we hire from? We hire from channels. Which channels do we hire from? There can be multiple channels. There can be referral. There can be campus. There can be consultancies, there can be newspaper ads, there can be social media platforms, which has now become a new trend in the hiring process. You start writing those. You say that, hey, look, I need to have a TA budget because I need to hire. Okay, within hire, there are two things. Where do you hire from? Why do you hire? Within where do you hire from, you need to find out which channel is the one which is making sense for the positions that you are hiring. So the second part, which was why do we hire, you get into the manpower planning mode and you say that, is this position required? I'm not getting into the overall manpower planning of the organization. I'm just talking about the requisitions that have come to you today to say, is this position required? If this position is required, what is the kind of approval mechanism or checks and balances that you have put into place to make sure that there is a criticality which has been established for this position? And the second part, wherein I talked about prudence and ROI, what is the ROI expected of this position if you were to hire today, from a top line contribution or a bottom line contribution? So with these three very base level, by the way, that the ones that I have put up are very simple to understand ZBB things. ZBB can end up being extremely complex. I've tried to oversimplify it so that we understand it properly. To say that using these three certain principles that we have identified, you create a proposed budget. Now you don't have a blanket TA budget. Okay, you have got.
Neelesh, I'd like to take a question here because I'm seeing a couple of confused messages on the chat. You know, we have a great question that, you know, well, okay, what happens if we go on zero mode for travel, but then our IT costs go up? So then how do we implement zero based to IT? I think that's a great question. And I just want to clarify this, right? Fundamentally what we are trying to do, we are fundamentally saying, close your eyes, blank slate on all your costs, right? Relook at your business model, relook at strategy. One of the big things which I had started this entire conversation was that when you look at the first step, in fact, before you do zero-based budgeting, is to really look what do you really want to accomplish, right? As Neelesh had said, you know, you have to look forward and see, this is what I need to do in the next 6 months, 9 months, 12 months, 18 months. Once you have those activities, then you come back and say, okay, I've put everything is down to zero. Now I need to add back. Hey, I can't travel I believe that we cannot travel for the next 3 months internationally thanks to COVID-19, right? So I'm going to put my travel cost as zero, right? Or a small amount of travel cost compared to what I thought it would have been had I been doing this last year. But then I say, well, if I can't travel, I need to have X number of online meetings. And there's a cost to that. Great. So I'm going to then instead of travel cost, I'm going to add IT HR costs into my budget and say my IT costs for ensuring people can work from home, travel, do remotely goes up. But the point is that eventually, as Neelesh just said, we have to reach a budget. It's not like we're saying shut down the organization. But instead of starting with last year's numbers, which have no longer any connection to reality, we start from zero and we said, in the new context of what we're trying to accomplish, what are we trying to do? To put a fine line on the example Neelesh just gave, he's saying, look, we may have to hire these people, right? Because we believe that there is a new opportunity that COVID-19 has produced. It might be a new product or a service, or maybe they have a critical functions you are in the middle of hiring and your organization can't survive without these. Could be a critical accounting function, or it could be a head of sales or somebody who really believe you need. But what you're saying is that, look, leave all your assumptions from last year out. This year, do we need this guy? Yes. This year, do we need to hire this person? Yes. Based on that, then you come out with a budget from scratch. So I just want to clarify this. This is not saying that if you bring all costs down to zero, you can say, okay, my work is done and gone. We are saying start from zero and add your cost up and start with what the new world you feel looks like. What are the new sources of revenue? What are the new functions that are important? If your travel costs go down, your IT costs will go up. But then you start from zero and bring them up. You don't take your last year's IT costs and say, I'm just going to add 20%, because the IT you need now, very different from the IT you had required. And the cost of that IT might be completely different from what it was last year. Perfect. Sorry, Neelesh, please go ahead.
Absolutely. I mean, while building up your IT budget, if you want to account for, let's say, a Zoom subscription for all your people, a premium Zoom subscription. Now, you will not, like Aditya said, that previous IT budget and 20% escalation because of COVID-19. No, that's not the reason. You will list it down activity by activity, that here are the set of IT enabling softwares for this purpose that I am buying, for this population segment that I am buying. This is the anticipated utilization rate in by virtue of utilization of this software and this expense. Here is the ROI that this will generate. Now, let's say if tomorrow all of your sales, if you've got a sales organization, were to start happening online, if your people were to start selling online, then they would need platforms like this. So you'll put a number against it and say that here is the kind of sales that this will generate and the ROI that is getting. So you put prudence into listing it down to the last activity where you want to do this budgeting, and then you bring in an element of ROI. That's exactly what we'll do into this talent acquisition budget that we're making. Step number one, once again, if you were to see, it said talent acquisition budget. Now this time we have said that talent acquisition budget is only focused on doing these 5 positions ka hiring. You will hire for the 5 positions that have been listed down. This time you've also defined the channels that you will hire from. These are not aggregated numbers. These are specific numbers, the channels that you want to hire from. So the first position you'll hire from a consultancy. The second you'll hire from referral. The third you'll hire from campus. The fourth you'll hire from consultancy, and so on and so forth. And then you've listed down hiring costs. These are arbitrary numbers that I've put for the moment for the sake of simplicity. At the same time, for each of these positions that you're hiring, you will put a top line contribution and a bottom line contribution anticipated in the time frame where you expect this position to deliver, which therefore means that ZBB will end up being significantly skewed towards sales positions, which will be the case. And that happens. That's a con of ZBB or a disadvantage of ZBB that we'll discuss with. But from an advantage standpoint, you've identified the positions which can bring you back onto the street with your feet firm on the ground, and the expenses that will go towards it and the ROI that will go towards it. Now let's say you start implementing this piece and you start progressing in this direction, and suddenly life changes slightly, wherein you say that position 5, which was a head level position, is no more critical, and I have gotten an internal person who can pick up this role and fill the shoes over here, right? Or suddenly the position is just not required at all. I have shut that business line, or that business line will not survive in the future, or whatsoever reasons. You put a stop hiring to it, immediately the budget goes down. While your top line contribution is going down, the budget goes down. This is the most important aspect of ZBB, which is its continuous nature, which you manage since it's activity based. Therefore, the moment you said that one activity got paused, which is here, stop hiring, the budget reduced from 3.4, which was here, to 2.0. Now, this is what is known as variability of costs. This is what is known as the resilience, self-resilience of your cost structure. I'm sure there would have been something which would have resulted into this decision which would have been taken, and many a times it may be because of certain cost constraints that you may have. Immediately it saves on to your cost elements the moment you start now cancelling activities. Otherwise, your TA budget would have remained what it would have, or you would have given a blanket cut and the business would have suffered somewhere. So this is the advantage of ZBB, which is just irreplaceable and extremely critical. So repeating back, you break and you start with a zero base, you break the activity into its constituent sub-activities. For every constituent sub-activities, you do a prudence analysis and you do an ROI analysis. And with that prudence analysis, you put a cost that is most appropriate for that activity to be expensed at. And the ROI analysis tells you the return that you will get by expending that much money that you have budgeted for this activity. A bottom-up build-up of all of the costs of the activities is going to result into your overall budget. At any given point in time, due to any scenario, an activity is getting cancelled or is getting stopped or is getting prohibitive, then the budget automatically goes down, your costs are automatically contained. So built-in resilience. Now, before I move forward, I'll quickly jump onto the pros and cons of ZBB. The first one is justified output. The output at any given point in time for a zero-based budget is very strongly justified for what it is expected to do, what you're wanting to do, and to the last activity level. So there are no so-called credit card hidden charges here, right? They are very clearly listed down on where the money is and where do you want to spend. The next one is self-correcting that I talked about, which is basically variability of costs, which says that if there are any changes to the business plan or the organizational plan, this budget self-corrects and brings it to the acceptable levels which would have existed without that activity being done. The third is that it's extremely efficient. It improves your operational efficiency by challenging the assumptions. Piछले साल we spent 5 crores in TA budget. This time we need 5.5. No, boss. Let's define what do you want to do, what is it that you do not want to do. The third is cost optimized. This model very specifically will take into consideration only those activities which can generate ROI for you, and therefore is cost optimized to bring your organization back from tough times to considerable great times. There are certain disadvantages that come. It's extremely time consuming because you'll have to break down every organizational activity to the nuts and bolts of making an automobile, to the wheat and barley of an F&B industry, to the 80 to not ATL BTL anybody we would count, to the last frills that go into the aviation industry for making your travel comfortable. It will go to that extent of costing for those activities, and therefore A, it is time consuming, B, it is complex, and three, it ends up having its own sets of implementation challenges because you need qualified personnel who can understand activities to that level and can do budgeting at that level. Your system should be able to take care of. So this was a quick view on zero-based budgeting for discretionary costs. Since I promised you that I will also be covering non-discretionary costs into it, I'll try and visualize with you together to say how is it that you can do it for non-discretionary costs. We'll go back to the example in some ways and forms and focus on this table over here. For the same position one, you will write top line and bottom line contribution everybody is clear about, and then next to it, you will put the cost of this resource, the past cost of this resource as 0. You will say that this resource should be at 0 cost. And then you will find out what is the right job worth of this cost with respect to market. Like for example, if you were to go buy a bottle of water in the market, you've got options. You've got a 1 liter Bisleri, which is of 10 rupees. You've got a 1 liter Himalaya, which is of 40 rupees. And then you've got a 1 liter of Perrier, which is probably at 200 rupees. Now, translate the same concept back to human resources and say that for performing a job, which is, let's say, a bottle of water, 1 liter, same content, but different quality, you will get resources at different costs. What is that right cost for you as an organization? What is your affordability? What you can pay? What are your strategic choices basis which you decide a certain pay positioning and assign a desired cost, a fixed cost to that resource? Now you put a mapping of what is the incumbent that is there, and that is where Adityaji's point also comes into place, that position versus incumbent. Do you want this position to have the incumbent who is currently occupying, adding value, not adding value, high cost, low cost, heavy cost, extremely high cost, and all of those jargons? And in some cases, incumbent versus position. Incumbent is adding extremely great value. The position does not require that much value to be added.
So, Neelesh, I'll just interrupt you there because I just want to address some of the chat questions. So I just want to sort of re-go through what Neelesh had done once again slowly. So what we are saying is that for non-discretionary, right? And what do you mean by non-discretionary? Primarily, we're looking at your organizational structure, right? And so every one of you have an org chart. You have departments, you have functions, you have everything from cost centers like accounting, finance, HR, and such. You have revenue generation guys, you have salespeople on the field, and then you have either production or service delivery, right? So you have either your manufacturing guys, or you have consultants who do service delivery, or you have specialists and such. what we're trying to do is just the way we looked at your travel budget. We say, look, we are starting saying that this company has 0 employees, right? And we have to ask a very simple question. To deliver our new business plan, our new strategy for right now for COVID and for the next 1 or 2 years, who do we actually need, right? What do we actually need? And then is to very carefully, step one is to start saying, okay, look, for example, we are going to continue to make this product. Okay, who do we need to make it? And then you start adding the people. Do I need I need a manufacturing head, I need a supervisor, I need 5 employees who do assembly. Or if you're in a service business, or let's say something like education, well, I do need 1 professor, I need 4 assistant professors to deliver this. So you add them back. Then you said, okay, back end, I do need 1 accountant at least, or 2 accountants, because I expect so many transactions to come, right? The idea is that as you start adding them back, you do the 3 things what Neelesh is saying. First, you try to identify why do you need that position, right? Do I really need accountant number 3? Do I really need an extra professor? Am I actually going to continue to be in this business line? Do I need another manufacturing head there? And that question you have to answer from 2 perspectives, short term and then of course long term. You might not need them the next one in the next 3 months or 6 months. You might need them after 12 months. And what we had advised last time, that if you need someone within the next 12 months, don't try to fire them. Try to figure out alternative options, because the cost of hiring them might be more than the cost of firing them right now. At that point, then you say, okay, this is what the role function require. So I need, let's say, a head of manufacturing, right? This is what I think the approximate market salary and all should be. This is what the roles, behaviors, and all this person is doing. And then you say, who do I have right now who is in that position? This person. And then what Neelesh is saying is, then you say, okay, is that person good for that role? Are they performing that role? Do they have the skills for the role that I am now imagining is required post-COVID? Do they have the productivity for the role? If this person might be a great person otherwise, maybe he's overqualified. Maybe you can take him, or you can upgrade his role, or move him to a different role which he might be able to do. Maybe he's unqualified for the role that he's currently in. You might be able to do a quick 15-day training program to get him up. You might need to ask him to move off and then hire someone to do that role. But the basic fundamentals of this is to start from scratch and add back people, assuming that your organization is empty, and then make a reason and rationale for why do you need each person you're adding back to your organization. Sorry, I had a bunch of questions on that.
Absolutely. So you do that analysis, and you will arrive at an organization which basically is the one which truly adds value. And when I say truly adds value, in the flesh and soul of value as it could be to the organization. And these are the guys who you need to make sure that exist in the organization. Everything else, by the way, now you do a delta analysis of what the zero-based manpower planning module throws as an output versus what my current payroll dump looks like. You do a side-by-side analysis of both of these. Anything that does not figure out on the left-hand side, which is the zero-based manpower module, is the one that you need to very critically look at. Do I need these people? Do I not need these people? And on the left-hand side, you need to look at, if I am required to spend 100 rupees on a particular resource, am I spending 90? Am I spending 110? And what is the value that every rupee that I'm spending is generating? So the person who's earning today 90 rupees generates 10 units of value for me. The person whom I'll be spending, let's say, 95 rupees on, may end up generating 25 units of value for me. Because that is when, once again, you'll do a market analysis to say that for 100 rupees spent in the market, what is the value that the incumbent generates typically? And is my incumbent also generating, not generating? So that's a person view. The first one was a person.
I just want to link this to a question that we have, right? So the easiest one, as Neelesh has said, was to do with sales, right? You say that in my industry, right, one person in the market from the same products, etc., is generating, let's say, 5 lakh of revenues, right? How much is one person in my organization at that same role generating? Are they generating 5 lakh? Are they generating 3 lakh? Are they generating 7 lakh? And that allows you to put an estimate on the value of that resource to the organization and whether they are meeting external benchmarks. It could be the same thing. For example, I'll take an education example since I used that in the past. A standard good professor internationally example is teaching these many classes. They are producing so many research papers and they're bringing this much consultancy revenue into the organization, right? For each of my professors, how much are they doing it there? And therefore, is this person compared to the benchmark to the market, is he an extra valuable resource to me? Or he is actually not, or is he a non-productive for the role that we are trying to assess the person for? Please go ahead, Neelesh.
Absolutely. So now, after having together visualized about this, about the zero-based budgeting for non-discretionary costs, there is one intentional con that we did not list out on the screen. And that was to say that a zero-based budget essentially focuses on profit centers. Where it does not find ROI, it ends up many a times being very brutal in recommending that, hey, look, expenses in places where ROI does not exist shouldn't be made. So therefore, hypothetically, what is the top line contribution that a position in the HR function will have is something which is very difficult to quantify. So a zero-based budget for HR may end up recommending zero resources for HR. I'm not saying that it will, but just as a thought process, it overtly focuses on profit centers. So that is one thing that we need to be mindful of. But other than that, this is one approach which can really help you figure out where to put your money. Where is it that it will be able to generate yield for you? Where is it that it makes sense to spend at the moment when there is a huge cash crunch? Aditya.
Ajay, thank you. And obviously this is not supposed to be a full extensive step-by-step. This is just an introduction for the concept. For many of you, I will try and maybe schedule another one in about a week where I'll sort of share some templates and such. What I'm going to do in the middle right now, we still have a good half an hour to go, is I'm going to paste the list of all CII webinars. These are updated all the time. They are open to all of you. Please do join. I am also posting our Telegram channel link, and you can download Telegram and join that. Or we'll continuously post slides, updates, some templates and such. We have also started 2 WhatsApp groups, which are broadcast only. So there's no discussion, only we post there. There are 2 of them. Please only join one. As you know, WhatsApp has a limit on 255. So whichever one you can get into, please join that. I have set that up. But just to close on the zero-based budgeting, I just want to recap the steps for everybody so that you're clear, and then we'll move quickly to OKRs, which are as important. The first step is to really understand what is your business model and strategy for the next year. And as Neelesh said, this is a continuous process. So you might not know exactly what's going to happen, but you do at least have to take a look. I believe, recovery, my revenues will start recovering in 3 to 6 months. I need to plan for next year. I think there's going to be a huge opportunity here. So you need to have a tentative strategy, if not a fixed strategy. But the beautiful part about the zero-based budgeting, it's not a one-day exercise. You make it once and then you continuously look back at it and see, does my budget reflect reality, right? Because reality is changing so far. So please don't think it's a one-time job where you've done this and you've left it, because what will happen under a crisis mode, in 30 days, everything will change. So you need to continuously revisit that. The second part, the entire point of a zero-based budget isn't to bring your expenses to zero. It is essentially to start from scratch and justify each expense. Why am I spending money on this travel budget? Why am I spending money on this raw material? Why am I spending money on this subscription for IT cost? And then saying, maybe I need to spend more money. Maybe I need now as things have changed, but is to really go back to the basics and ask those very hard questions that there. And I'll give you an example. There are a lot of organizations which I know, which have expensive subscriptions to software or to journal or to things, which they've been doing for the last 10 years. Chal raha hai, right? Nobody remembers. It always comes up in the budget. It gets renewed. right? And so the idea is to go back and say, no, wait, we aren't a fat organization anymore. This is going to be a crisis. Let's start and only focus on what we essentially need for this. And then on the non-discretionary part is take a very hard look at your organization and start from scratch and ask the questions, is that what sort of organization structure, who are the people, the roles I actually need for what my strategy or what I think is going to happen in the next 12 months, 18 months, and then sort of go on into actually saying that, okay, this is a critical role, who is occupying them, and is it on a benchmark, something that is really, is this person delivering for my organization or they're not delivering from my organization? A quick question from Amit. Amit, please should have asked on the Q&A, but you got on the chat. Thank you. Neelesh, thank you for pointing that out. How do we measure ROI on functions like stores, warehouse staff, or do we consider it as a production team? So I'll give my 2 bits, and Neelesh, please give your 2 bits on that. See, there are 3 ways you can measure ROI on backend functions. One, you can group them into the production team at a level beyond that. You have, for example, if you have an assembly line with 5 people, you can't ROI each person. You have to say assembly line runs at this efficiency, needs 4 or 5 people. This is the productivity and capacity. And I need 1 warehouse person as part of that assembly line team. And they produce X amount of productivity on manufacturing. So, Amit, so one you can do is you can combine them with teams to establish what they produce, right? The second to look at is also is essential staff. Can you run your warehouse without that person? If you can't run that warehouse without that person, and that warehouse is important for you to achieve your other ROIs, you need that person back. But then you have to look at the productivity. Is this person able to operate the warehouse at the same efficiencies? Are they able to the stacking, the cycle times, the picks, the deliveries at the same rate that an industry comparable there? And so you can, for example, on a warehouse, also then match on a productivity basis to do ROI. I need a warehouse person. I estimate that warehouse person needs to do at least 20 orders per day. My guy is able to do 40. So he does have some room where he can do more, but I need those 20. Or you can say, look, the average guy is able to get out 100 boxes per day. My guy is only doing 40. And then you have to see that, okay, his ROI and productivity has to be decreased. The third way, particularly for functions such as HR and accounts, you can also look at means comparable added value. So for example, if you have a recruiter, right? And if you went through alternative channels like consultant, like this, like that, but you have a salesperson, right? And if you went to an alternative channel, right, it would cost you X. But because you have this person in-house, you are getting the same service at 50% or at 80% off. And so in effect, they are generating that revenue back to your organization, because otherwise you would have to spend them on an expense. So that's the third way of accumulating ROI, is saying that, look, if this is an essential service, if I outsourced it, it would cost me X. But since my guy is doing it, and him plus his cost, his team, his rent, his chai, pani, kharcha, overheads, milakar, this guy, all thing is cheaper than the outsourced guy, then that is the ROI value they are adding to your organization. So those are the 3 versions that we normally use. Neelesh, anything on this question?
So picking up on your part of productivity, Aditya, the point for all cost centers is their contribution to bottom line. Now, how is it that you can quantify it? Every product that you go and sell in the market, or service for that matter, has a clear contribution, has a clear product costing, and has a margin. So therefore, for all, let's say, stores employee, picking up on your thought of productivity, what is it that this individual is contributing to the bottom line of the organization? And if it was to be optimized, then what is the margin that the product can, what is the margin in the product that can be improved? And therefore, how does your competitive advantage change with this bottom line improvement? So all cost centers, the ROI is to be costed in the bottom line. That's the only addition that I have in addition to the 3 methodologies that you spoke.
Just a few questions. I have one from Ishita. Why start from 0? Why are you wasting time? Great question. This is very hard to implement. So we're starting from zero for, as I mentioned at the start, because all the assumptions that you're based on are no longer valid. Your revenues are no longer valid. Your costs are no longer valid. Your market is no longer valid. You don't know who your customers are going to be. You don't know if your export orders are coming in. You don't know if you're going to get clients. You don't know if you're going to get students or admissions. You don't know how you're going to operate. You don't know if your office will be open, how much rent you will have to pay. You don't know if you need IT costs to make up for that. So because all your assumptions are gone, you have to go back to zero. And the second is because you're trying to save costs, right? So the intelligent ways to save cost is not to say, oh, everything was there already. I just need to cut 20% of my cost. Where can I cut? Again, you're working on wrong assumptions. The reason you have to go back to zero is because your assumptions no longer work post COVID-19. It's the reason why it's called a black swan. It's the reason why it's called such a big catastrophe. It's the reason why everybody and every government is struggling to respond, because everything we knew about the world, how markets work, how much money is there, whether we'll get loans or we won't get loans, whether our customers will pay us, when they will pay us, how will they pay us, what products do they want, how services they want, when will exports open, which countries will be buying, which services will come up, which will not come up, how will a customer and consumer behavior change? All of this has changed. So the reason why you have to waste time reinventing everything, because what you assumed is now gone. And that's why coming out with the zero-based budget will allow you to address that entire problem as well. Will zero-based budget also mean re-engineering the org structure, which can be a tedious and long-run process? Absolutely. Now, again, emergency calls for emergency actions. I would rather you spend the extra 72 hours, 1 week working day and night, reinventing your org structure and making sure that it's accurate than just firing people left, right, and center. It's much better to actually consolidate and figure out what your new org structure looks like. Neelesh and I had this conversation during the last webinar that normally you take 6 months and 1 year to do an org structure redo. But in times of great emergency, in times where you're trying to cut costs, because most of your organizations are going to tell you, we need to cut 30%, 50% of our HR costs, right? If you do that without relooking at your org chart, you're not going to strategically succeed. You're going to have a huge problem with this. And therefore, you need to relook at your entire org structure, and you need to look at it strategically, because otherwise you will make mistakes and you will cut costs and panic. Great questions on that. I am going to now quickly, because we only have maybe 20, 25 minutes, is going to discuss quickly OKRs. And I am going to, and the reason why OKRs are so important is, well, I'll let the presentation talk. Brilliant. Okay, so OKRs. Now, what happened during COVID-19, right? Everybody did work from home. Suddenly, organizations had to go from 0 to 100 in understanding who was working, who was not, who's stepping up. How do you even measure? Most organizations, quite frankly, had a performance system, whether they liked it or not, or it was designed or not. They just had one by default, right? Whether it was face-to-face, I see you, you must be working. I don't see you, you must not be working. Or they had, very classical appraisals and such. But, in a crisis like this, yearly and even quarterly objectives are no longer relevant, right? So all of us had, for those who had implemented very nice balanced scorecard systems, or had put nice, quarterly objectives, SMART goals, all of this, suddenly all of that, your quarterly objectives are no longer relevant. We are all in crisis mode. We are running and we don't know when we're going to see the light of day. It might be 3 months, 6 months, 1 year, but setting quarterly objectives, 6 months objectives, yearly objectives in a time of crisis and change does not make sense. With a fast-paced changing of market dynamics, an agile and flexible approach is required for goals. So what an employee needs to do for the next 2 weeks will change in 2 weeks, will change in 1 month, right? So you can't say, oh, this is a classic role, let's do this for 3 months. And anyway, to be very honest, most organizations in India particularly, people just set quarterly objectives and goals. What they really do has nothing to do with that, because the dynamic nature of the Indian environment in general struggles against quarterly and yearly goals, because things change on the ground. And now this is a huge problem that people are facing, right? With remote and work from home, we need a better system that can track and push performance. You're not seeing these people every time. You don't know what they're doing. Most people aren't even used to understanding how people can work from home. So you need something that supports you to at least understand what's happening and what is your work connected to somebody else, what you're dependent on, what they are dependent on. And performance needs to be measured quickly and accurately in order to make tough decisions on HR. We just talked about the entire zero budgeting. And the reason why we're doing OKR with this right now is that how do you even know who's performing right now? How do you even understand who your good guys are, or the person, if you're waiting for 3 months or 6 months for their appraisals, you will make horrible mistakes in not rewarding the right people and penalizing the wrong people because your performance system isn't giving you good data. And the last part is you need data now to understand, is change is happening in your organization? Is your strategy working? You've changed the way you work. You've changed the way you do your billing system. You've changed your products and resources. You've done all of these changes, but can you wait 3 months to understand if it's working or not? That what's happening in the organization? You can't wait 3 months. You can't wait 6 months. You can't wait 1 year. You need feedback immediately. OKR, and I'm sure Neelesh will cover the history on this, was developed. The biggest proponent of it is Google. It has, most of Silicon Valley has adopted it. A lot of Indian companies are adopting it. And there's a huge number of high performance organizations around the world who are moving to OKR and hybrids of OKR systems. And so in the next 20 minutes or so, 25 minutes, what I'd love for Neelesh is just to cover an overview and broad-based. We will be posting in either the WhatsApp broadcast group or the Telegram WhatsApp group. I will paste a couple of manuals from the experts on OKR. We will post some templates as well. But the fundamental underlying thing, what you need to understand is whether you use OKR or a hybrid of OKR or something else, your performance measurement and management needs a drastic change. For the next 3 months, for the next 6 months, for the next 1 year, you cannot do business as usual. Okay, Neelesh, over to you, please. Go ahead.
Okay, so the concept of OKRs is something which isn't new anymore, like we talked about in our last session. This has been in the country for a fairly long time, and a lot of organizations have adopted it. They're still in the early stage of adoption per se when it comes to, let's say, a product being mass adopted, and there aren't a widespread adaptation of this process because of its nimble and agile nature, because we've been traditionally used to, as individuals as well as organizations, to have goals which are 1 year long in nature, and therefore over a period of the entire year we fix up our scorecard, or rather let me call it, we game our scorecard to work it on our advantage. OKRs fundamentally, rather than being people measurement system, they are truly performance measurement system. Now, what is the fundamental difference between what we do today or what should be done is to say that OKRs are performance management archetypes or performance management processes per se, which not only just manage the performance of the individual, but are also responsible for managing the performance management. When we talk about, we always mix it up with
Neelesh, you might have to repeat what you said. We lost your voice for the last 2 sentences.
Oh, my bad. So I'm saying, is it better now?
Much better. Please go ahead.
Okay. So fundamentally what I'm saying is that the purpose of performance management system is not only performance measurement of employees, which is essentially known as appraisals, but performance management of the organization as a whole. OKRs emphasize on the performance management of the organization to see whether the organization on the right performance management trajectory or not. So what are OKRs? A way of goal settings. The acronym's full form is objectives and key results. It was introduced in the Intel Corporation and from there has been widespreadly adopted in the Silicon Valley, has seen sustained adoption in the country that we live in. It talks about two things. Number one, where do I want to go, which is an objective. Objective basically talks about what do I want to achieve or where do I want to go. And the second is how will I get there, which is KR or key results. They are numerically based expressions of success towards achieving a particular objective. So in other ways and forms, a way of KPIs in large way and forms are indicators for key results, which are helping me achieve that objective or not achieve that objective. So this was the definition of OKR. Now in the next part of it, we will try and bring OKRs together. OKR is like I said, where do I want to go and how will I know whether I'm getting there or not, are of two forms. Number one, you've got a organizational objective, or let's say for sake of simplicity, a team objective. And then you will have certain team KRs or team key results, which will help you determine whether you're achieving them or not achieving them. Once those team KRs have been identified, then the incumbents who are tagged onto it are the ones which will have their individual KRs or individual key results. So this is once again a bottom-up approach. Like a BSc or an MBA is a top-down approach. This is fairly a bottom-up approach to say that individual KRs roll up to the team KRs. The team KRs, if they indicate the right progress, show that whether the objective has been achieved or not. Now, there are certain behaviors and habits that come as part of OKR. So you've established business outcomes in terms of what objectives need to be achieved and what key results need to be, what key results will be measured to see whether you're reaching there or not reaching there. There are habits and behaviors which are defined in OKR to say that if I was to behave in this particular manner, if I was to do these things, then there is a high possibility that the key result that I'm wanting to obtain shall be obtained and therefore fulfill the objective that it is wanting to fulfill. Now, the most important part in establishing OKRs is twofold. Number one, you should be able to define the objective. What is it that you want to go or where is it that you want to go, and its associated key results, which most aptly measure the progress on that objective. That is one part. The second part, which is more difficult to implement, but equally important, is have you established the right team structure, which therefore means to accomplish these objectives, whosoever is that individual who's contributing to the KR of this objective will be a part of the team for that objective. Now, please take note, I will repeat. Any individual who is contributing to the KR of this objective shall become a part of the team for that objective. This is fundamentally different from the way we organize ourselves today. We organize ourselves today as finance function. We organize ourselves today as sales function, HR function, and so on and so forth. But if the organizational objective is to improve net promoter score by 10%, then the customer service teams, the sales teams, the production team, the HR team, the finance team, whosoever is contributing to that objective by means of key results that they will achieve to measure that objective will become a part of that team. Slightly
Absolutely. Just to give another example for this, and this is something very relevant to a lot of organizations, right? Neelesh, you can just go back for into that team objective. You know, a lot of times what happens is that because one of the biggest things that OKR does is it breaks out the silos that we have in organization, right? Somebody sitting in finance who is processing incoming checks or who is processing payments, or someone who is working on accounts receivables or payment receivables may not think of themselves as part of the sales team. When quite frankly, quite frankly, the entire sales process, they are an essential part of it, right? And so in a traditional KPI, KRA driven model, they might have a KPI or KRA that has something to do with making it easier for customers to pay. but their key result as a team is not intrinsically linked to that sales team, right? Making it easy, for example, for a customer to pay would also link into the sales team. It would link into the customer service score, which is called the Net Promoter Score and such. So one of the big parts of why this is so important is that you need to quickly break down the silos between functional roles and establish who is actually required to deliver on that objective. And that is one of the key things that that Neelesh is talking about in really driving why OKR makes a difference. Sorry, Neelesh, I thought since you had a couple of questions on that, I'd put a fine line under it.
This is the example that I give every time when we are talking about OKRs. John F. Kennedy walks into NASA. Apollo mission ka time hai ye, and that is when he asks the janitor, "Sir, what are you doing?" The janitor replies back saying that, "Hey, look, I am helping the world put a man on the moon," right? So the janitor's key result is tied to that objective, and therefore he is a part of the team which is putting the man on the moon. Now, this is a very exaggerated example of OKRs, but one very important thing that OKR does is that it gives me as an individual at the junior most level or at the middle level or at the senior level a visibility of what is my contribution to the overall organizational objective that we are wanting to achieve. How is it that my pressing two buttons on the computer is going to impact the bottom line or the top line of the organization? Because this chain goes right from top to bottom and goes to and fro. It isn't one way, it's to and fro. What you do impacts there, what they do impacts you. Now, coming on to an example of it, on the left-hand side, it basically talks about generally how is OKR, how are OKRs looking like. So let's say if one of the objective of your organization is to improve the net promoter score of of the organization in Q3. So you define a very objective, a very quantitative objective to say that you want to improve 10% net promoter score in Q3. So let's say if your net promoter score was 20 the previous quarter, this quarter you want it to be 22. By the way, 22.
Neelesh, you might have to give 2 sentences on NPS. I don't think most of our audience might be familiar with the concept. If you could just explain that for for a couple of sentences, so the example sticks in their head.
Sure. So net promoter score basically is a survey done with all the people who have availed your services at the end. And when I say services, it could also be supply of goods, to say that to what extent would they recommend your supply of services or your supply of goods on a scale, on a let's say 5-point scale, to others, or would want to reuse your services. I'm trying to explain this in very layman terms. There is a technical definition to NPS, but fundamentally, how would they recommend your sales and services to themselves, which means they want to use it again, or they would recommend it to the world. So let's say the top two ones say that I strongly recommend or I recommend are the ones which determine your net promoter score. So if of 100 people were surveyed and 20 people are saying that they want to recommend your sales and services for themselves again, or to their other peers who would want to utilize your services, then your net promoter score will be 20%. This is a clear indication of how good or bad are you from a client satisfaction standpoint. A lot many times organizations also use CSAT service, but NPS is a more holistical way of looking how your organization's goods and services are perceived by your clients or customers. So 10% improvement of NPS in Q3 basically means if you were at 20, you want to go to 22. Now, what are the key results which will impact NPS, which therefore in one simple ways and forms client satisfaction? If there is no defect in the cycles that you run for the organization, for the product that you supply, it's a high possibility that your NPS score may improve. So now think of it, improving NPS score to production, right? The second one is release frequency every 2 weeks, which therefore means that if the demand cycle is such, and by the way, this is contextualized for an organization, so I'm trying to explain, if the demand cycle is such that you have to make sure that every 14 days the product gets delivered to the individual, your release frequency also has to be 2 weeks to whatever it was earlier. right? So this key result specifically focuses on how many times were you able to release it in 14 days or not. The next one is 100% UAT pass. So this is more of a software solution standpoint where UAT is user acceptance testing. The user should be able to accept your product in with 100% accuracy. It shouldn't so happen that out of the 5 modules that you rolled out of the sandbox is the place where you do all sort of configuration and coding. Sandbox to the final UAT stage, 100% of it gets passed to go for live, right? So these are the 3 results, if done, shall measure whether your NPS will improve or not. Now there is a likelihood that NPS may improve by 10% if you were to be absolutely certain on these 3 key results, if these 3 key results were to be achieved. Now these are team key results because there are multiple people who will be working on it. So what would be individual key results if, let's say, this was a software project? Adherence to coding standards. So if there are certain coding standards that have been established, if you 100% adhere to it, there is a likelihood that there shall be 0 defect in the cycles that you are wanting to run. Mentor junior developers. If you were to teach your junior developers who are coding for you, then there is a likelihood that there shall be 0 defect. Picking up another one, 100% UAT pass. The key result for the individual is work with business to understand business better. Let's say if you have understood the business process extremely well and now you are basically trying to codify a business process, then your understanding determines how much of it has been translated into the program. So therefore, as an individual, if I can say that Neelesh Gupta has learned the business process very well, then there is a likelihood that there would be 100% UAT pass. Now see, from team to individual, this is the cascade that has happened. And one cascade is from down, the other also can go up. When you say that, hey, look, all the teams need to work with business users so that there is a UAT pass percentage increase from a KPI standpoint. So these are the OKRs that we established for individuals and teams. There are certain behaviors.
I just want to take one quick question. I think there's a lot of confusion on how KPIs fit in. You can take this key result and just replace it with KPI. It's the same thing. So basically what we have is an objective, and then we have how do we measure that objective. And these are, for example, 3 KPIs: 0 cycle defect, this a key performance is a 0 cycle defect escape, the 2-week frequency, 100% UAT pass. These are all key performance indicators. So please don't get confused between HR jargon. KPIs are an intrinsic part of this. It is not different at all. But the key learnings of this is that 1, the team-based approach, and 2nd, the introduction of the team and individual behaviors. So for example, it could be as simple as showing up to office on time as a key behavior. That is going to make sure that, you know, if you're saying that I want 100% on time customer calls to be taken, and if you say my customer can call me between 9 a.m. and 9 p.m. at night, making sure that 100% of people arrive at 9 a.m. and an individual arrives at 9 a.m. is ready to take a call is 100% behaviorally linked to accomplishing that goal. So it can be as simple as that. Please go ahead.
In fact, that is a very apt story. And let me go back to my pre-consulting days. And I used to have a boss. And if that boss sees you in office at 9 a.m., throughout the day, whatever you go to that person with, there is a very high likelihood that it will get approved without any glitches. And if you're not in office at 9 a.m., if you drop in at 9:30 or 10 a.m., then there is a very strong likelihood that whatever you go to him with is likely to get rejected. So it's a very strong efficiency measure that, by the way, you spoke of right now.
Fair enough. Great. Please go ahead. We have about 5 to 7 minutes, so we'll try to wrap up quickly on this, but please don't worry. I just want everybody to understand the power of the concept. If you all want, please message us, or we will figure out a way to do a more in-depth version for both. But we will be putting up manuals for OKRs. We'll be putting up templates. We'll be putting up executive summaries. Please join the Telegram group. Please join the WhatsApp chat groups. Go ahead, Neelesh, please.
Perfect. So in the interest of time, let me run up the express for COVID-specific OKRs that we want to drive. Let's pick up an HR team as an example. In today's tough times, while cost control is on one hand, I specifically picked up this example wherein we said that we let's say maintain employee engagement at X% in Q1 is one of the objectives that the organization wants to achieve. Why? Because everybody is feeling at the moment frustrated and all of those things are happening. So you want to maintain employee engagement because fundamentally you believe that engaged employees are productive employees and so on and so forth. Wonderful. So this is the objective. For the team KRs, we have split it into efficiency and effectiveness. I've only taken one example of effectiveness, but there should be more examples of effectiveness. From an efficiency standpoint, which basically says that is the process happening, not happening? KPIs and key results, for the sake of this discussion, we'll use interchangeably. So the KPIs that we've picked up is that monthly pulse survey should result an engagement level of X%. This is an efficiency measure on how are you measuring it. Number two, if your people are engaged, they should be attending wellness program. So wellness program has a relation to enhancing engagement. So you say that if the attendance in wellness program is at Y%, there is a high likelihood that employee engagement may improve. Zoom adoption, which is the kind of platform that we're using today, if that is at a particular percentage, it is an indicator using the technology and working towards the betterment of the organization. Now think of all of these as unrelated KPIs, right? When will you link Zoom adoption to employee engagement? In tough times like these, when you know that Zoom is the only mode that is available, more and more meetings are happening. There is a high possibility that people are discussing important business. So you're linking these team KRs from an efficiency standpoint to the objective that you want to achieve. Now, from an effectiveness standpoint, I've taken only one example and I'll spend a minute on it to basically say that if you had defined organizational OKRs for your entire organization and divided them into teams which function towards achievement of those OKRs, then start monitoring these OKRs and see what is the state of completion of the organizational OKRs, whether it is towards the front line or whether it is towards the back-end operations or whether it is towards support functions. If the organization as a whole is achieving its OKR at A%, whatever you define as that A% number, you are good to go. By the way, be rest assured that OKRs never end up being achieved 100%. You mostly end up achieving 70 to 80% of the OKR that you have set for yourself. So you start measuring that as an effectiveness measure, which will in a way indicate that your organizations are working towards achieving those organizational objectives and therefore are engaged. Now coming to individual KRs. How are these team KRs linked to these individuals? So I've picked up only one, which is wellness, and then defined individual KRs. There is somebody who shall be responsible for launching an e-wellness program. So design and launch of e-wellness program, one number by this particular date. If this KPI is met, this is not a goal per se, but if this KPI is met, then there is a high likelihood that the attendance of wellness programs will get enhanced because you would have launched a wellness program. There is Mr. B who's responsible, who's from a different team now. So Mr. A was, let's say, from the HR team. Mr. B is from the corporate communications team, internal corporate communications. This individual's job is to implement the socialization plan. So therefore, to create the socialization strategy and roll it out to the entire organization. Then you've got an L&D person who basically was nominating employees from, or the business HR business partner who was nominating people to this wellness program, is the person who nominates and then tracks attendance. So Mr. B and C together track this attendance. Now ABC became a team to ensure that employee engagement as an objective gets achieved. Now this is the power of OKRs, wherein you have created bite-sized objectives which can be completed in the span of time that we have today. And at the end of the exercise, you can measure the effectiveness as well as the efficiency of the performance of people that is undergoing these tough times and these challenging times. So this, in at least my limited opinion, are one of the most appropriate methodologies that organizations can use today.
Brilliant, Neelesh. Thank you so much. We are a bit out of time. What I want everyone to do is please join our Telegram channel and such. Join our groups. We will send out lots of stuff on OKRs, manuals, and all as well, which have more in-depth summaries. But we hope that during this time, you have gotten a great overview of two very important concepts that organizations can use during this COVID-19 things. One is the zero-based budgeting for HR, and which, by the way, can be used across your organization. It's not just an HR thing. You should use it across your entire organization to revisit all the assumptions of the past and prepare your organization for the future. And this OKR system, where now you have business objectives directly linked to teams and individuals. And so even if you're working from remote, because people have bite-sized objectives that they have to accomplish, which are very strictly measurable, you know that they're accomplishing those objectives, and at least everybody has clarity on what they are doing, as well as then what the team is trying to accomplish. So rather than waiting for a quarterly or a 6-monthly or a yearly update and trying to do a realignment every 3 months or every 1 year or even 2 years, you are able to focus on alignment on very, very critical business objectives and drive them through individuals and drive them to teams. And we didn't have time for this, but on frequency, you can do an OKR things every week. You can do it every 15 days. There are companies who normally do it 15 days if they're trying to move faster during the crisis. You can do an every month realignment. It's a much faster system than the traditional ones we've used in the past, which have a monthly or a 6-monthly or a 1-yearly goal. This particularly works for non-sales teams because you can have a lot of very interesting discrete business objectives and activities, which may not depend on revenue KPIs as much, which are far easier to measure. It's very easy for us to measure monthly sales or weekly sales or quarterly sales. This allows you to measure a lot more that's happening in your organization, and that is really delivering value to your customers and all. With that, thank you so much, Neelesh. I'm sorry we ran out of time. I think we should have done maybe 2 separate webinars, one on each. But I'm also grateful for all our attendees for sparing your time. Please, if you want to join CII as a member, use the link I've sent you, ciidelhimember.org. All our webinars, including this one, will be there. We will be posting all the templates and updates on the Telegram channel over the next week, the OKR manuals that we have, and we will also be posting them on the new WhatsApp broadcast only groups. Those groups are only broadcast only, so don't worry, it's not another WhatsApp group with 5 million forwards. It's just, it's just the updates on the webinars. Anishi, thank you so much once again for putting together this in almost 4-5 days short notice. And thank you again for everybody at CII who's worked hard in the background to making this happen. And I look forward to seeing all our attendees in our next webinar. Thank you. Be safe, be slightly paranoid, but be positive. Have a great evening. Bye-bye.